Okay, why don't we get started here? So I'd like to thank everyone for joining. I think we're going to have a couple more people kind of trickling in over the next couple of minutes. What we really wanted to do today is spend some time going over our 2024 executive pricing survey. So my name is Michael Stanisz. I'm a managing partner at Revenue Management Labs here in Toronto. And I have the pleasure today of walking you through some of the insights that we've garnered through our executive survey that was completed at the end of 2023 and coming into 2024. And what we're really looking to do here is really push out some of the information. We're going to leave some time at the end for questions if you can drop those in the chat. But really, we wanted to kind of bring to the limelight what we're seeing as the benchmark and performance for pricing over the last year, what we're seeing going into 2024, and some of the things that we really see successful companies doing. So what are companies that are winning, what are they doing, and what kind of strategies they're taking around their pricing strategies, how they're setting up their teams, and what they're doing. So I won't go too much into the background of the deck here, but what I wanted to do is really get into how many people we talk to, who we talk to, and how you can kind of access some of this information. So we surveyed over 500 executives. So you can see there, we talked to CFOs, CEOs, chief revenue officers, anyone in a senior position that would actually touch pricing and be responsible for pricing. So that's one caveat that's really important to note, is that we specifically looked for people who had responsibility for that pricing function and for driving that top line revenue. We looked across 9 industries. So consumer goods, business services, medical technology, pharmaceutical, healthcare services, manufacturing, distribution, software, and technology. What you're going to see here today is an aggregation of all of these different industries. In the next week or so, we're actually going to be launching individual benchmark surveys for each of these industries. So additional to this, which is the aggregated view, you're going to be able to see 9 specific cuts, specifically by industry. The other thing that we're working on launching is a data set where, if there's interest, you can access and be able to see some of these benchmarks for yourself and be able to compare, where does my organization sit as I look at different organizations, where they sit, and really help you guide where your pricing has come and where you expect to see it over the next 12 months. So with that said, let's kind of jump in. There's a couple of different sections. I'm going to spend a little bit of time talking about the pricing benchmarks for 2023. But most of the time I'm going to spend today is really talking about what are successful companies doing that are overachieving some of those benchmarks. So we have a couple of different cuts here, but really what I wanted to kind of dive into is looking at the overall benchmark when we look at price increases, revenue growth, and discount change across North America and Europe. And this is really important for us because this is one of the pieces of feedback that we got when we launched our soft launch last year, is that the European market was asking us to be able to look at their data separately because they thought that the nuances and what they were seeing in those regions were very different than North America. One thing that we found really interesting as we look at the high-level benchmark across both of these regions is that when we look, every single region, both North America and Europe, and across industries as well, were very aggressive when it came to setting pricing targets. So in North America, just over 5.5% was the target. And in Europe, they were a little bit more aggressive with just over 7%. What's really interesting is that both of these regions under-delivered their targets in terms of actual performance. Now, you can see that they were quite close when it came to their actual performance. But what's really shocking to us is after we overlaid the discounts and started to understand, well, what was that net price that they were looking, the actual realization came down pretty drastically. So in North America, the target was about just over 5.5. People were able to push across about a 5% price increase on average, but they only realized about 3.5% or just under 3.5% price increase. And this is a theme that you'll see me talk about time and time and time again today. What we really saw, whether it be in any industry in North America and Europe, we saw very consistent increases in discounting, and a lot of organizations struggled to meet their pricing targets because the discounting increased as well. The nice offset to that, though, is as we look at total revenue growth, we can see that there was some volume expansion and some growth with new customers because clients were able to really drive almost everything they were expecting from that total revenue growth. So what you can see in North America, the expectation was just under 4%, a little bit more aggressive in Europe. And you can see they were pretty close, right on the button, very, very close to where they were expecting to be. When we look at the same view from an industry lens on the price increase, you can see that, again, the increase in discounts substantially lowers some of those net price increases across the board. Now, what's interesting to find is we don't see as much of that decrease in certain industries. So distribution and consumer services were much closer to being able to achieve their targets. But when we look, especially across the pharma and the med tech side, they were they had much more trouble actually passing through and had to push in some of those discounts. Now, one thing to note is these industries typically are industries that we see more longer term contracts. So as we take a next cut of this survey next year, that's going to be something that we're really going to be monitoring to see if that improves over time, because sometimes in those industries, the discounting structures are much harder to change than in a distribution and consumer goods setting. One thing that we just wanted to call out here is that, there were a wide range of price increases that we saw across the market, ranging from about 4 to 8%, but by far the biggest increases we saw were in consumer goods. And remember, inflation running at about 3.5%, both in North America and Europe for last year. So this is well above and beyond inflation. A lot of the reason is trying to catch up for some of those cost headwinds that have been with us over the last several years, but very aggressive pricing targets as we've seen over the last year. We'll come back to this at the end, where we'll start looking at where people are projecting to be in 2024, as we know the expectation of inflation is going to be a little bit lower. Whether we actually see that or not is yet to be seen, but we'll kind of come back and see where people are planning on to be in 2024 as well. Now, there's a lot of other slides here where we cut the industries in terms of revenue growth, and there's a lot of different cuts, but I'm going to skip right ahead because I think the real meat and the value of what we want to talk about is really around what are successful companies doing. And as we analyzed the data that came back, we found that there were 6 big things that organizations who were able to outperform were doing in terms of pricing. So when we talk about an organization that is high performing, they were able to get more pricing, they were able to drive more revenue, and they were really able to drive that gross margin up. The 6 things, and I'll go in depth into each of these, but they may seem obvious to someone who works in the pricing world because we've preached these things time and time again, but now we can really start to see the data that backs up that these are things that winners are doing and that those who are outperforming their peers. The first thing is really around the C-suite engagement in the pricing decisions. You'll see this is a really interesting finding because it's as much about the discounting as it is about pushing that frontline price. The second thing that we found is really the second thing that we really found is really the people who are monitoring price on a regular basis, specifically monthly, way outperform those who are doing it on a less frequent basis. And what's even mind-blowing here is you'll see there's a clear cutoff of where we see some of those performance indicators of how you should be looking at that pricing conduct. The third thing that I'll talk about is really instilling the sales team with greater responsibility. Now, this is an interesting one because this is almost counterintuitive to what a lot of organizations have been moving to in the last couple of years. We've seen a lot of movement into limiting the amount of discounting that people can do and really trying to control some of that spending. We found that actually when you're giving them more responsibility and you have more leeway, that there's actually better performance on the bottom line. I think one thing that everyone's really interested in hearing about is the investment in artificial intelligence. We're seeing a lot of investment from a pricing standpoint into that capability across the board. I have some thoughts on that as we kind of go through and look at some of the findings that we have. I think one thing that has been touted time and time again is having a dedicated pricing team. Now, this is really, really important because you'll see that those organizations who have that dedicated function really outperform those that don't. And one thing that I've been preaching for many years is that having a balanced approach to your pricing strategy is really beneficial. And those who are taking that balanced approach are driving better results than those that aren't. Now, when I say a balanced approach, I'm really talking about not only looking at value-based pricing, not only looking at market-based pricing, but making sure that we're taking into account what the market can bear, what the competition is doing, how much value we're driving out there, but more importantly, what's happening with our cost base. We know that the costs have increased significantly over the last 3 years in a lot of industries, and it was very easy to just kind of pass that cost along. We're seeing those that take a little bit more of a surgical approach to look at the market and the value are doing much better than those that are just using one of those levers. So as we jump into these kind of 6 key success factors over the next couple of minutes, I'm going to bring some data that really came to light as we dove into all of the responses from these over 500 CEOs. The one thing that I'll call out too is, if you recall, I mentioned earlier, we're going to be having a cut of this come out that's very industry specific. And what you'll actually be able to do is we have specific industry insights of what people in these industries are doing that are driving to success as well. So they'll be a little bit different than what you're seeing here, but should also add an added degree of value to everyone. So let's jump in and see the data because that's really my favorite part here. The first thing that we looked at was in and around when we look at the C-suite's involvement. So on the left-hand side, you can see those companies that performed in 2023 that did have the C-suite's involvement in the pricing decisions. And sorry, that's on the left-hand side. On the right-hand side, we have the companies that didn't have the C-suite involvement in the pricing decisions. And there's 2 things that really came to light when we saw this. The first thing is that we noticed that those companies who were involving the C-suite were setting the targets much higher. So you can see about a 7% difference or 7% target for those that had the C-suite and about a 6% for those who didn't have the C-suite. So right off the bat, when senior leadership is involved, the target's set a little bit higher and the threshold is there. Now, when we look at the achievement of the target, there's not much actual difference in where they got the actual price increase, that dark green bar. But what's even more shocking to us is that when we look at the net price increase, there's a big difference. And a lot of that net price increase was not only driven by the higher target, but it was also driven by the discount change that we were seeing. So not only is the C-suite setting the target higher, when they're involved in the pricing decision, but they're able to hit that target a little bit more frequently, but they're not putting as much discount in the system. And what's happening is they're really starting to control how much discount is going out to that customer. So that's one thing that, as we sit back and we look at where people are going with their pricing decisions, that net price, the discount lever, is just as important. And we're seeing that there's a little bit more rigor on making sure that that discount isn't increasing when the C-suite is involved. What's even more interesting, when we kind of double clicked down into the C-suite, we found that the discount change that they were doing year over year was actually much smaller. So what we have here is the sales team discount limit. And what you can see is that the discount limit is actually much higher when you do have the sales team involvement. So it's really interesting, because what that's telling us is that the C-suite is giving their team the ability to discount, but knowing that that information is going to come up and they're going to be part of the pricing decision. There's much more rigor, not only from the C-suite, but from the sales team, to actually make sure that they're not giving away as much discount. And with that approval authority, we know there are some tangible benefits to them having a little bit more leeway. You're going to get to quicker sales cycles. If they know the C-suite's going to be reviewing it, they're going to want to control that. And ideally, that's going to lead to more revenue and higher margin. So it's really interesting that as that senior engagement is there, they're part of this decision cycle. We're seeing that even though it's sales controlled, we're not seeing that push. And you can really see that in the discount change. The C-suite, was almost 25% less than when no C-suite involvement, and it shows in the margin. You can see that a substantial increase in the margins that these companies are getting when they're involving some of those executives. So right off the bat, one of the things that, if you're not doing it, you have to give the senior leadership visibility into the pricing cycle and what's happening. Now, I'll caveat that with, you have to be a little bit careful here, because not every decision can go to the CEO. Not every decision can go to senior management, but it's really important that they're part of seeing a report, understanding what's happening, having a metric that is coming up to that senior leadership, and making sure that they have visibility into what's happening from a pricing standpoint, because that's really going to help you drive that bottom line. But also, don't handcuff the team too much. And I'll talk a little bit more about those discounts a little bit later, because that's something that kept coming up time and time again as we went through the data. The next insight that we really saw was around, I'm just changing the slide here, the companies who were doing, how often they were reviewing their pricing. Now, I strategically kind of put this insight after the first one, because what's really interesting about this is, I talked about the CEOs and the C-suite can't necessarily be part of every decision. But what you can do is, if you are reviewing the pricing, if you have some reporting around it, and you can bring it with a rigor of frequency to the C-suite, that's a way to really get them involved and make sure that they're part of the process. Now, what we looked at is the revenue growth and the gross margin in general of companies. And we looked at, does that look any differently when they're reviewing their pricing decisions on a monthly basis, a quarterly basis, semi-annually, so twice a year, or annually? And one of the interesting things that we found, I think there's two things here. One is that companies that are looking at their pricing on a monthly basis far outperform those that look at any other way. So you can see that it doesn't matter whether you're looking at it quarterly, annually, semi-annually, not much impact Not much difference between those three versus when you're looking at a monthly basis. So it's really, really important that if you don't have a process for reviewing your pricing on a monthly basis, you start to build that routine up. What's even more interesting here is that if you say that's totally impossible, the benefit of looking at it quarterly or semi-annually versus annually, there's not that much true benefit there. There's a little bit of variance in the numbers, but for the most part, you really get that jump when you start to look at the data on a monthly basis. So there might be some synergies if you truly can't look at it on a monthly basis. That does it really make sense to invest in quarterly or to do a more rigorous process on an annual basis? But by far and away, it's important to try and get as many looks on a monthly basis as possible. What's even more interesting is when we looked at the discount ranges for some of these companies and how often they looked at it. So here we looked at what is the price increase, the discount change, and the net price. And as you can imagine, the amount of price that companies are driving when they look at it on a monthly basis is better than all of the other ones, but it's not substantial. It's not what we saw on the previous slide around gross margin and revenue growth. Where we see the biggest impact is when we look at the change in discount. Those who are reviewing pricing on a monthly basis, you can see that their discount change is only about 0.5%. Everyone else is hovering in and above that 2%. So what's really interesting is it's not the ability to pass that price along. That's the benefit of looking at your pricing on a monthly basis. It's really the diligence around making sure that you're not giving too much discount away. It's having control of that discount. Ties very much to what we were talking about in terms of engaging the C-suite and being able to have them as part of the process. We saw the same thing, that discount is much better. So it's not surprising to see those two are correlated. What's really interesting and was really surprising to me is of all the companies that we talked to, of over the 500 executives, only about 12.5% of people were reviewing their pricing on a monthly basis. Very few, less than 10, were looking at it annually, but by far the biggest amount, 46% and 32.5% respectively, were looking quarterly and semi-annually. So when we look at this, we see a huge opportunity for companies to improve their discounting, because what's going to really happen is as they look at that discounting spend on a monthly basis, they're going to be able to get much more control. So it's not necessarily a frontline pricing issue of how much increase I can get, because they're still pushing out those increases. It's that they're spending back those increases. So the ability to get on a monthly basis, really understand what's happening, really, really can help drive that bottom line, because it's going to create more control. So huge opportunity to be able to move to monthly discount reporting across the board. And this is something that you'll see. We saw this across a lot of different industries. As we jump in to the next kind of insight here, this is one that was particularly surprising to me, and I talked a little bit about it during the C-suite point. But what we looked at is what happens when we give our sales team the ability to spend discretionarily. And we looked at the 2023 actuals and the 2024 estimates. So this is companies who are even estimating what they're going to do in 2024. And we looked at the range of discounts that they let the sales team give discretionarily. So 1 to 4.9% means that the sales team, without discretion, they can give up to 5%. The next bucket is about 5 to 10, and you can see we've done the rest in about 5% increments. What's really interesting here is when we looked at the discount increase and how much discount they're expecting to spend over the next year, so 23 over 24, we saw that there was a significantly larger number expected for those who had lower discretionary limits. So it's interesting because as we see this, we're not letting our team spend as much. We're handcuffing them a little bit, but they're really going to increase their discounts much more than we see from the teams that have a little bit more leeway and can go a little bit more. You see the 20+% bucket, not much difference there. We're really seeing the big year over year jump in what they expect to spend in discounting when their limits are a little bit tighter. So it's interesting because the flexibility gives the team a little bit less incentive to kind of push those discounts up. And it's the same thing that we kind of talked about. It could be the CEO involvement here as well. But one of the really big things that could be driving this is how people are thinking about their discounting strategy and how they think about uh, oh, I see a question there. We'll get to it in a second here. And how they think about what they're going to do with a price increase. We looked at the same bucket, so the 1 to 5, the 5 to 10, and so on, and we looked at how much price increase are they expecting to get or do they push in 2023, and how much did their revenue grow? And what's really interesting is those smaller buckets. What we saw was that they were targeting much smaller price increases and they got much less revenue growth as well. So they're not targeting really big price increase and revenue growth. On the other side, where there's much more flexibility and they're letting their sales team give bigger discounts, what we saw, much bigger price increase targets and much higher revenue growth. What does that mean for us? Well, what that means for us is it looks like the strategy that these companies are employing is really pushing price up and really making sure that they can get as much price as possible, knowing that they're going to be spending it back and actually spending back that money and giving their sales team higher limits to be able to spend back. And what that's leading to is higher price increases and higher revenue growth. Now, it's interesting because as we look at this, what we see is that everybody's looking for a deal today. We're seeing a lot of pushback from buyers and a lot of people are asking for discounts. And by having the handcuffs and really planning small increases with no increases to discount, it's a tough route to market and it's a tough conversation to have with customers. Whereas it looks like these companies who are employing some of these more lenient discount structures, they're already planning to take higher increases and they know that they're going to have to deal a good amount of that back. But from a perception standpoint, it looks really good to the customer that they're willing to give some bigger discounts, that it looks like there's some good faith happening there and they're not as stringent on that. And that's being reflected in the price increases and the revenue growth that they have. So really interesting finding. And I think a lot of what we're seeing from how they limit their discount is actually being driven by the individual strategy of the organization as well. One thing that I'll kind of point out too is that almost 60% of the respondents have a 10% or below threshold that salespeople can actually give discretionarily. So it really, really begs the question of what's the right strategy to be pushing across? Is a better strategy to increase that discretionary discount, but overinvest and push more frontline price, knowing that you're going to be giving some of that back to end up with a higher revenue growth and a higher net price? Now, I see a question from Robert there. Do companies who give the sales team more discretion on discounting, is that coupled with net sales and gross margin target? Absolutely. And what you'll see and there's some subsequent things that we see an increase not only in the revenue growth, but that's coming right down to the net sales because we're seeing not only is the net price up, but the revenue growth is there too. So right across the board, across all of the metrics, when we see more of that discretionary spending, we're seeing that. Now, I will caveat that I think a lot of that is driven by the strategy that we're seeing here today. It's not necessarily let's continue to do the same strategy and give more discretionary spending. The two have to really come together where you're pushing those higher prices, knowing that you're going to spend some of it back more discretionarily. So it's a really coupled strategy. The last couple of insights that we have here around what companies did really well. When we look at, excuse me, where people are investing and where they're spending time to build that pricing capability. Now, we asked across a lot of different investment vehicles. We tried to look at, is it data and systems? Is it training? Is it headcount? Is it consulting resources? And by far and away, none of those had any correlation to performance. Where the correlation to performance was around machine learning and AI. Everybody is looking at machine learning and AI and investing significantly into these places. Even when we look at companies who are looking at revenue growth, gross margin, price increases, net price, the actuals between here, the performance is really on those companies who are investing in those spaces. Now, I got to caveat that by saying that one of the things that we don't know from the survey is we don't know what baseline infrastructure that some of these companies have today. So our thought really was the companies that are investing heavily in AI, they've probably already invested a significant amount into pricing capabilities around headcount, around data and infrastructure and systems. And really, they're taking that next step to a proactive solution. So it's interesting for us because, yes, we see this as a big investment vehicle, but the one thing that I always caveat is that you have to be a little bit careful with AI. We need to make sure that we have a strong foundation before we really start pushing some of those more innovative solutions. If you don't have the right headcount and the right team, and you don't have the data and systems, investing in AI probably isn't going to yield much result. So our thought here is really that these organizations probably have a good baseline already, but that's something that we're going to be exploring in next year's survey, is really pushing the boundaries of what are people doing in these spaces around AI and really double clicking on what do they already have. The next is really around when we look at companies who have a pricing team. Now, for those of you who work in the space, this should be an obvious. This is something that we've been preaching for years and years and years, to have a dedicated focus on a pricing team and having resources that are looking at this on a daily basis. When we look at revenue growth, when we look at price increase, and when we look at net price increase, so this is the net price that people are trying to get across, we see that time and time again, the team that has, or the organizations that have a pricing team are able to outperform those who don't. Now, the one caveat is that when the executives are really, and there's no pricing team, but the C-suite's kind of the decision maker, the price increases push far, but you're not getting that as much net price realization. And I think that's really the last graph on the right-hand side says it all. When we look at, on average, where that net price realization is for people who have pricing teams, it's really, really significant. Not only do they outperform on price increases and revenue growth, but that net price realization is significantly better than when it's run by finance, sales, marketing, and C-suite. One thing I always ask people is, how many people do we have working in the marketing department, in the sales department, in finance? Typically, we have big investments. These are very traditional roles in the organization. Rarely do people have a big pricing team. I'm not saying a big pricing team is necessary, but even a couple of people who are solely focused on driving this metric, it can have a big, big impact on the organization. Lastly, we looked at one of my favorite things, and this is really around taking that balanced approach to the pricing strategy. And when I say a balanced pricing approach, I'm really talking about making sure that we're not only looking at the internal costs and what they're going up, we're taking a look at the competitive landscape, the market, what's happening there from our competitors, but also the value that we provide to customers, and does it exist? People have been talking about a value-based pricing strategy for years, and that's the way to push. Perspective that we have is a value-based pricing strategy is a great start, but it needs to be coupled with what's happening in the market and the cost realities. What we found is people who are taking the balanced lens approach, when we see their net price increase, they're actually getting more price in the price increase. So what that's telling us is that balanced approach, they're getting the price increase, but they're reducing the discounts. This is really, really impactful, because by looking at all these lenses, not only are they pushing that price about 1% higher, but they're able to reduce the discount. And that discount, it's almost a 3.5% swing just on that discount line. And you can see it's almost double the net price performance. So it's really important that as you build up those strategies, don't sit in one world and only look at costs. Don't only look at what's happening in the market. Take that balanced approach and look at all those different pieces to make sure that you truly have a balanced way of looking at how you're building your pricing strategy. So those are the 6 big things that we saw companies who were successful and outperformed do in 2024. Now, sorry, in 2023. Now, as we look to 2024, there are a couple things that I just want to touch upon in the last couple of minutes around real trends that we're seeing in the marketplace. The first thing that we're really seeing companies talk about is 2024 is really a year that they're looking to expand margin. We know that 2023 was volatile. Inflation costs kept coming up more than we had expected. Last several years, tons of costs kind of coming up. Really, that 2024, there's a huge focus on increasing that expected margin. And what we see is that the expectation is that some of it's going to have to come from price. You can see that when we look at the 2024 expectation of how much is going to come from price, we see almost 7.5%. We see an increase in discount, but really it's about growing that sales and pushing that price. And they're really looking for those 2 things to continue to drive the margin improvements in 2024. So a lot of people were expecting lower prices kind of coming into this year. I think that as we look at the people that we talk to, the expectation isn't necessarily going to be as muted as some of those inflationary numbers that people are seeing. There's still a lot of executives are talking about the need to push price and close that gap, probably playing a little bit of catch up from the previous year. So when you look at some of the numbers in our 2024 benchmark, where we see when we look at what we're expecting, you can look at it by industry, you can look at it by region, but don't expect the prices to be as muted as some other forecasts are kind of talking about. And we're already seeing some of that in 2024. We've seen continued increases across the board in a lot of different industries. One thing that's really interesting to us and very much expected from our side is that when we started asking, well, why are we trying to increase these prices in 2024? And what's our rationale? And the 2 things that really came out, we asked a lot of different factors what could be driving it. And the 2 things that came out were really around retaining and attracting customers and an increased value offer. Now, what's interesting is when we talk about retaining and attracting customers, one of the things that, as we first started digging into this, we thought, well, that's really weird. Why would you push your price up to kind of, attract new customers? And what we're seeing is that there's a big expectation that the higher price realization is going to come from new customers. So really, in our world, the way we think about that is that's mix. The expectation is that new customer mix is going to drive that price realization across the board. So the expectation is that the new customers who are going to be coming in, they're not necessarily going to be getting as many of the discounts that we saw in previous years, that we had to retain some of those customers over the COVID years and kind of coming out. We're going to have much more flexibility to be able to really charge a higher price to some of those new customers kind of coming in. The other thing that we saw really was around increasing the value offer. A lot of the organizations talked about bringing new value, adding value-added services, adding features, really bringing a different experience to what they have been offering today, and really thinking about revamping their offering to get the ability to charge that higher price as well. So again, it's not the customer mix. Now we're talking about the product mix. So all in all, a big focus that we see the executives having on really driving those two pieces of mix to help them achieve their 2024 targets. I'm seeing a question here. This might be a bit tactical and referring back to earlier slides. Was the intent behind adjusting discount strategies primarily to boost immediate sales, or have you noticed a trend towards maximizing customer lifetime value? Yeah, that's a great question. We didn't necessarily ask that question, whether it was a short term or more of a long term. One of the things that I think we want to ask as we kind of get further down into our next one, but my hypothesis around this is that we saw a lot of this happen in primarily industries that are more longer contractual. So my lean is a little bit towards they're trying to create longer customer lifetime value. So when we look at industries that typically run on, let's call it 2 to 5 year contracts, we're seeing that happen as well. We're seeing a little bit of it happen in industries where, it's more day-to-day transactional business, but really what we're seeing is more in those contractual type based approaches. So what's really interesting for us is the hypothesis is that they're trying to get those customers in, and once they have them for that contractual period, their product is sticky, they kind of have them there, and then they're able to really renew some of that as they kind of go through. Next question I see is, can we claim the successful pricing policy based on the survey results consists of constant planning and human factor? Does this type of research have risks? Yeah, I think absolutely. I think, what I would say is that when I think about a good pricing policy, it's all about the consistency. It's all about making sure that you have the right people and you're giving them the flexibility they can do it. But I think these are things that we kind of, I think, already knew a little bit. But what's interesting is that this research is really validating some of the things that we knew. I think what's really important as you think about implementing some of these things and as you bring them to your organization, I think the biggest risk is making sure that you have control over what you're bringing into the system. So what I mean by that is when we have a situation where we're saying we want to give more discretionary spending to the sales team and giving them more flexibility, we need to make sure that we are offsetting that with the price that we're taking and that we're planning to kind of give that back. And we're consistently monitoring, because if we're seeing that they're going even above and beyond that, or we're not getting that uptick, we need to be able to respond in a quick manner. So one of the things I think that is key in any pricing policy and any pricing strategy that you put together, it'll be really important to make sure that you have the visibility into what's happening and you really have the ability to track that. And from what we saw, it's on a monthly basis, because it's really those discounts that are burning people at the very end here. So we're up at time here. I'll open it up to any questions if anyone wants to stay after. But one thing I'll kind of call out here is After this section, we get into some of those pricing estimates and the benchmarks for 2024. You can get this document. It's available on our website. So go there, look for the executive pricing benchmark, pull down the document. Feel free to reach out if you have any questions about methodology, about diving in. And look over the next week or two, we're going to be releasing some of those industry specific reports that are going to deep dive really into those 9 industries that we talked about. With that, I'll show you a couple slides here, but you can see this is really where we're expecting some of the pricing to go in 2024. And with that, I'll leave it there. If anyone has any questions, feel free. I'll stick around for a couple minutes if you want to drop them into the chat box. If not, if you want something more confidential, please feel free to reach out, and we'd be happy to connect with you. Thank you guys very much for the time today, and I hope you guys took some value out of the session.